Next is Walmart, but kind of not Walmart. So I had a look at Walmart's results. This is, of course, Friday the 21st. And yesterday, Walmart reported earnings, and the market in general had a bit of a wobble. So it's not the earnings themselves that were particularly either interesting or worrisome. They were fine, basically unremarkable. Sales were up sort of 4.6% on the year. And of course, they knew three quarters of the year already. So this is just Q4 and the full year results for 2025. I mean, maybe that's why people are so interested in what's going on. They're telling them what's going to happen in 2025, but it's their guide for 2026, as they call it, which the rest of us call mostly 2025. That has been kind of catching people's eyes. So they're looking for sales growth between 3 and 4%. That's lower than the 4.6% of last year. Earnings per share between 3.5% and 5.5% higher. So that's a bit weak. But the thought here is partly that Walmart is a decent insight into what consumers are doing in the US and how they're feeling and what their kind of spending is going to be. And that weak Walmart guide has come into a market that has a slightly high feel about it in quite a few places. It feels like there's optimism priced in, and people are prepared to be optimistic while at the same time realizing there is something obvious that could start going quite wrong. And that thing that's obvious that could start going quite wrong, not saying will, not saying even likely to, but everyone agrees that the potential threat here is inflation. And there's inflation coming from potential tariffs driving up costs because of pricing power it basically gives to US local producers over imported ones. And immediately higher prices on imported things. Deportation of low-paid workers driving up labour costs, so higher prices get pushed through to consumers. And if inflation goes high and you then find interest rates coming up and bond yields fall, and then everything starts to go a bit wrong. But even inflation by itself could slow consumer spending. Consumers can generally put up with a couple of percentage points a year. Things get more expensive. That's just life. Hopefully you get wage increases that cover it, or at least some sort of interest on your cash that offsets the worst of it. What won't work so well is when inflation starts ripping higher and you start getting to big numbers here, and that really weakens consumer spending. And consumer spending, as Steve and I were discussing last time, I won't make him pretend to not know the answer this time, is just over 66% of US
Isn't it 33?
GDP. It's not 33. It's still not gone back to 33. It will be at the rate, but by the time we finally get this show out, it's going to be 33% of US GDP. But at the moment, it's about 68% of GDP. And I was saying, if something made up 68% of your business, and that's where you were looking for growth and revenues and the like from, you'd be paying pretty close attention to that. And signs of weakness, you probably wouldn't panic, Steve. And I get the impression that you're not really panicking about this either.
No, not particularly. Look, from Walmart's point of view, same store sales growth of about 4.5% is pretty decent. This was a 4.6% actually. I think it was a decent enough report. It's a slow growing company with some pretty interesting bits and pieces that are kind of tacked on the side of it, but they're not the first company to warn that retail growth was a bit soft. There was Burger King and Popeyes, their report from Restaurant Brands, that they said they'd had a weak January that when they were given their guidance. They said it was down to a cold winter, some winter storms, perhaps some consumer just taking a small break after splurging a lot over the holidays and Christmas, and also the damage and disruption from the LA wildfires. I think they're all temporary things. They're not a huge pattern of change in consumer spending. So not particularly bothered about any of that, Steve. It's again, stuff like this is never interesting to me. It's interesting to me to read as an investor, but it doesn't change the way I invest. Walmart's got some pretty interesting arms to its business, Steve. They said that the global membership income has grown by about 16%. Some of that is from the subscription-based membership program, Walmart Plus and Warehouse Sam's Club as well. Its global advertising business grew 29%. There was a 24% increase in Walmart Connect. Its third-party marketplace and fulfillment services segment, which basically packs and ships orders for other people like Amazon, also rose by double digits. So these are all interesting little high-margin, faster-growing parts of the business where, they're not affecting things at the moment. Walmart's a big business, and it's hard to bring something along that comes around and affects it in any kind of way. But they will have a positive effect on Walmart's margin as time goes on. Interestingly, Steve, just to go back a little bit, I've just spotted on CNBC that Steve Cohen's now got a pretty negative view. He's just turned bearish on his view of the economy going forward. And he says this is mostly down to a number of things with the government, but basically the immigration crackdown, the punitive tariffs, which he rightly calls just taxes, increasing taxes, but also this issue with the Department of Government Efficiency. He said that basically he's turned bearish for the first time in a long time, and he said that tariffs cannot be positive. They're not. People are misinterpreting them. It's just a tax on the consumer. But also the issue with slowing immigration, which means that the labour force will not grow as rapidly as it did over the last 5 years or so. And he also pointed to the Doge cost-cutting moves, which is trying to save around $2 trillion of spending. I think $2 trillion of $6 trillion off the top of my head, Steve. But he said all that is a stimulus, essentially, because that money's coursing through the US economy and has been over many years. If you stop it or reduce it, that's negative for the economy. That money doesn't get fed back into it. And he thinks we're heading to a bit of a regime shift. He doesn't think it's a long-term, a long-lasting thing. But he said he doesn't think it's going to be a disaster, but he would not be surprised to see a significant correction. So that's interesting, Steve, I thought.
Yeah, I wouldn't be surprised to see a significant correction either with the way this is going, partly because we had a decent-sized push after the election result that I didn't think was justified quite yet. As always, we will see, and if there's one thing I'm more sure of than anything else, it's that you and I on this show, at least in our investing lives anyway, will outlast this US administration, better or worse. I'm not saying the next one will be any better. But whatever's worrying you at the moment, it will eventually pass, I think. And if you stick with the strong businesses in this, they will likely find themselves in a better position coming out the other side, is my general approach here. You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.